Well, good day to all you price action traders. Name is Dr. George Nyabadza. My Facebook page is Master Forex Price Action. I have a WhatsApp group with a similar name. If you want to be part of this group, just send me a message on the Facebook page and I'll add you onto the group. The reason I've put this together is a lot of questions I get from the traders that I coach on how to become profitable. Now, that question really takes you a long time to get to answer for yourself. It takes years and a lot of time and practice to become a good trader, and that means a profitable trader who actually enjoys what they are doing. One of the things that I have learned over time, and I continually sharpen myself and refresh myself on this, it's a key part of my trading rules, is to always search for a few well-managed trades, because if I have a few well-managed trades that I am looking at, it becomes easier for me to make money. And the idea of being in this game is to make money. So let's have a look at this daily chart that I've got. It's a daily chart of the Aussie dollar, as you can quite see. Now, there's a concept that you need to understand and grasp as a trader, and that is that markets are fractal. In other words, whatever you see in one chart, this particular section is a range. This you would see on any other time frame, although I'm looking at a daily chart. Okay, if this was a 4-hourly chart or an hourly chart or a 5-minute chart, they would all look the same. I could block this out and you would not be able to tell whether this is an hourly, 5-minute or 4-hourly chart, because markets are fractal. So the patterns that you see that will repeat themselves on any time frame. So for the purposes of looking for a few well-managed trends, it does not matter what chart you're looking at. In this case, it's a daily chart, and the market entered into a range. And what I want to talk to you about is just the number of trades that you could take and the amount of time you would need to wait in order to make money out of your trades. It's very critical for us to understand that as traders, in order for us to become profitable in the job that we have and to enjoy what we do. The selection of the time frame that you trade is really dependent on what you want out of trading. Most of us get into create wealth and to create time for ourselves, for our families, for our friends, for the sports and hobbies that we have. So you need to choose a time frame that works for you and stick to that time frame. The other thing you need to bear in mind is that psychologically it is proven that our minds and our brains can only really keep track of 7 plus or minus 2 chunks or bits of information. And what that means is that at any given time, your mind is able to keep track of between 7 minus 2, that's 5 bits of information, and 9, 7 plus 2, 9 bits of information. So as far as trading is concerned, you should really be looking at between 5 and 9 charts, depending on the time frame that you're trading. When I trade the 5-minute chart, which I love to do, and I typically do that on Fridays because that's when I have a free day out of other activities, then it's a whole different ball game. I like to look at one chart, and I've got 6 currency pairs that I look at, but I tend to choose one and just focus on that because of the frequency of the changes in the bars. If I'm trading an hourly chart, I can have several options open to me. If I'm trading a daily chart, then you have a lot more options. So be very careful about your selection. Understand how the mind works as well. So back to the chart that we're looking at. So the market entered into a range from a bear trend. And when you get a break of a trend line, it's an alert. I call that a major trend reversal alert. It's an alert that the trend is about to change. It has been broken. So the trend may transition into a bull trend, or the trend may carry on as a bear trend. The trend may resume. That area in which the transition is likely to happen is a range. It could be an extended range, it could be a short range, it could be a narrow range or a broad range, but it's a range, and the range has got ways that you can trade the range. So as we can see from that, particular perspective, the market entered in, started off and entered into that range. When a trend line is broken, I'm always anticipating that the extreme is tested. So that becomes the upper part of my range, okay, and that lower part, the trend extreme, becomes extreme of the range, the bottom part. So this is support and this is resistance at the top, and within that I have the range. But I need to wait for the opportunity to trade because I'm emerging from a bear trend. When the market breaks a trend and creates a setup as it did there, that's a legitimate trade to take. And if you take that trade, you'd put your stop above there, and then you'd wait to see if your take profit level is hit at the bottom of the range. At this stage, the range transitioned and created a higher low trend reversal. We can discuss that at some other stage. So there's an opportunity there. If you're in that trade, when the market begins to go sideways and create a higher low, you could tighten your stop to that level or look to exit at the next sign of bullish strength. Okay, so if you exited or if you tightened your stop, you would have been stopped out at that stage. However, because you're in a range you want to buy low and you want to sell high. You buy low to initiate trades or to buy out of the short trades that you had, take your profits, and then initiate a bull trend going up. Buy long to go to the top of the range, to that level that you've marked out as a level of resistance. If you had done that, taken a trade at this entry or that entry, your stop, I always say, is at the nearest technical level, which the most conservative is here. Alternatively, if you want a tighter stop, you can put it there, and then you aim for a take profit at that level, at that rate. If you had done that, you could have achieved a 2-to-1 return, a 2% return. If you're only risking 1%, that's 2-to-1 return. By the way, I only risk 1% on any trade at any given time. And I also only limit my risk to 1% on my whole account. Risk management is something we can discuss later. At that stage, that's the range extreme. You take your profit. You do not wait or start to think the bull trend is carrying on because you have determined, you've assessed that there is a range. So you take your profits and you initiate, you start to sell. You sell at the top. You sell out of your bull positions, or you sell to initiate a trend, a bear trend. There is no signal as yet for you to go bearish, so I would wait to see what the market shows me. Very next bar, market reverses back into the range. So you could take that entry there, put your stop at that new extreme. Alternatively, if you want to be conservative, you'd wait for a second entry. I tend to prefer second entries just to be certain that my position, my reading is correct. So I would wait before I take that next trade. If I had waited, that's the same pattern we're looking at. I would have then initiated a new trade there. Stop above that, that becomes my new range extreme, so I could move my my level of resistance up there. And I'm aiming to get to the bottom of the range. Okay, so I would take that, put my stop, and then just leave it. The idea, if you had a look here, 1, 2, 3, 4, 5, 6, 7 bars, that's 7 days of trading on the daily chart. Or if it was an hourly chart, it's 7 hours. If it's the 5-minute chart, it's 35 minutes. All it requires is patience, irrespective of which chart you are trading. Similarly, if you take the trade there, leave your stop there, and you are aiming to get to the bottom of the range. And let's see what happens. Okay, so what happened at this stage? Price moved all the way into the middle of the range and pulled back. So two ways. You could have, after taking that trade, and price moved to a 1-to-1 level, tighten your stop to break even, in which case you'd have been stopped out at that point in time. Or if you'd assessed that the market is reversing back, and that could be a new higher low, first low, higher low, second higher low, you could have closed your trades at that point. Alternatively, if you'd left it out and still believing that it's going to transition without tightening your stop at 1-to-1, you would have still been in the trade because your stop would have been above there. I would have tightened my stop at a 1-to-1 level to break even. Okay, tighten to break even and then leave the trade. and I would have been stopped out at break even. Typically, I have a lot of trades that I take where I move after a one-to-one level is achieved, move my stop to break even. So I find that I have plenty stops, but I'm not losing money. In any case, there is another entry you could take. Now, remember your range extreme has moved from here to here, so there's a perfect double top that you've got. But you may not have traded because of that doji bar there. But when you see that that bear trend bar, put an entry there, put your stop above the range extreme, and again you want to hold until you get to the take profit level. And again, what you need to just bear in mind is the length of time that you would need to be waiting from here down and all the way back. Okay, it is time, it requires patience, but these are good trades. Okay, there is one trade that we took, okay, would have been stopped out with less than 1%. If you took that trade at that level that you broke out, easily have made 1.5, maybe 2%. If you took that trade, maybe you would have been stopped out at break even. You took that trade, let's see what's happening. But you're not messing around and in and out and chopping out of the market all the way through. And that is where traders tend to get hurt because we are impatient. You know, we want to follow the market and keep moving with every bar. That's a quick way to lose money, and it's completely unnecessary. But it comes with a choice to be self-disciplined. In any case, you put your entry over there, and there's your stop, and you're aiming for that range extreme. Okay, so you still would be in the trade. Market pulls back and gives you a second entry. Okay, so that second entry could be a lower high from there. The bar is pretty large, so you'll have to manage your position to stay within your overall risk level. You can put an entry at the close of the bar, put your stop at the range extreme. You're still aiming for one-to-one. In a range, I tend to aim for one-to-one at best. This is a large range, so it might give you an opportunity to make a lot more. Would I put my stop there? I'm pretty conservative in terms of where I put my stop. I could put it there, but technically you could put your stop there and you still hold to see if price would get to that extreme. Price did get to that extreme, so that would have been a good return. And again, what you want to see is almost 2 weeks that you're waiting, and if you've been waiting from there, it's almost 3 weeks of waiting that you've got. Whatever time frame that you've got, the idea is there's a lot of price action, but you've only taken 1, 2, 3, 4, possibly 5 or 4 if you haven't taken that trade, and you're making money along the way. You know, you might have been stopped out, but if you moved your stop to break even, you're not losing money in any case. Price rushes to the bottom of the range. Now, do not start to initiate shorts here because you see this, because it's not a confirmed breakout. It is just a range extreme. Your mindset is that you trade in a range. Let's see what happens with price. Same thing happened here. Price broke above that and immediately reversed back to the range. So here you're looking again to buy low because you're at the bottom of the range and you want to aim to get to the top of the range. But you wouldn't buy because of that strong bearish bar. You'd wait for more price action. There's the opportunity. You can take that trade to go to take profit at the top there. Put your stop at the bottom here if that's what you had in mind. If you don't like that first trade, well, you can wait for another entry. There's a second entry. Stop in the same place and then wait to see what happens. And price still hits your take profit level at the top of the range. Now look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 29, 30, 31. That's almost a month of waiting. Now if you take in weekends, you're talking 6 to 7 weeks of waiting, but it would have been worthwhile. I hope you enjoyed this, guys, and we will catch up again at another point in time. Thank you very much. This is Dr. George Nyabadza. Enjoy yourself and happy trading.